The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. E.G. Tax.
It's Ask the Tax Lady with Esther Gulius and E.G. Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to keep you abreast of what's going on with your money relative to taxes and tax planning. And you know, there's been a lot of stuff bandied around the last few weeks about the proposed tax changes, and we're going to keep you up to date on that. And of course, in studio I have Tiffany Fabian and Christopher Fabian. Hey guys.
Hey there, Esther.
Hello, Esther.
Hello, Christopher. Hey, Tiff. I will tell you, before we get into some of the things that we wanted to talk about, we also want to talk about what we promised we'd talk about 2 weeks ago. And we did briefly last week, but we were going to give more information on the STAR program. And before we get into anything with taxes, income taxes, let's talk, Chris, about the STAR program.
Sure. You know, everybody knows the STAR program is what helps you save money for your school taxes that are due coming up soon. And
homeowner, right?
Yep, if you're a homeowner. And so in 2015, New York State revamped how it works. So if you're either a new homeowner or you just signed up for the STAR program going from 2015 forward, you will not see the STAR savings on your October property tax statement. You will see 100% of the tax.
So they're holding our money hostage?
Yes. So then New York State will issue a check back to you eventually. And we don't know when, because there's still people waiting for their state refund from this year. So
yeah, and that's really the problem, is that when New York State controls the writing of the checks, sometimes you don't know, you have to keep calling and calling and calling and calling and calling in order to get the money, and it becomes very frustrating. So let's go over this again. If you're already enrolled in the STAR program and you didn't just recently get a new house or just enroll, you're good to go. It's going to be reflected on your October school tax.
Correct.
However, if you just bought a house or you just enrolled in the STAR program, it won't be on your property taxes. It'll be a check that's sent to you from the state.
Yes.
So Chris and I just bought our house in 2016, so we're screwed on that front.
So, yep, good way to put it. But yeah, and the under 65 people, it's nothing to do with your town anymore. You have to go on New York State's website and register yourself. If you're over 65 and are doing the enhanced STAR, then you can go through your town, because they have different criterias.
All right, but that's not something where they're going to send a check to a senior.
No.
Right? So that'll be reflected on their school tax.
Correct.
All right. So we did talk about it last week, but we had Mike and Glenn last week on the program, and they are prolific speakers, and so they certainly, you can't. It's hard to steer the program when you got Mike and Glenn. So people called last week and said, "I thought you were going to talk about the STAR thing." We said we did, but not for very long. So if you have any questions about that, 803-0930, 803-0930, star 930 on a cell phone. And I'll tell you what we want to talk about today. We're going to talk about some of the changes that people that are involved with Harvey, the hurricane, can do, because there's some regulations that have been loosened up. There's also proposals with the tax law changes. And again, this is before Congress puts their 2 cents in it. We want to talk about that. And we also want to talk about taxable and non-taxable income, how when you have a decision, how you can make something that's taxable potentially non-taxable income. But before we get to that, 803-0930, 803-0930, star 930 on a cell phone. Let's go to line 1, and we'll talk to Mark. Hey, Mark.
Hello, Esther.
Hey, what can we help you with?
I don't have a Harvey the Hurricane question.
That's all right.
But I hope you can help me with it.
Yeah.
I'm the executor for my mother's will, and part of what she had was in the form of an annuity.
Okay.
Now, the last several months of that annuity, we're talking about a small amount of money, but the last several months of that annuity have not been paid out, and basically I'm talking with the insurance company and asking them for a lump sum payment, and they're sending me a form that says income tax withholding. They want to know basically how much federal tax and how much state tax I should withhold.
So you're going to be getting the remainder of the annuity, is that correct?
My brother and I, yes.
All right. How much are we talking about, Mark?
We're only talking about maybe $4,000 at the most.
Okay, and Mom had funded this annuity, right?
Yeah.
So that means that part of that annuity anyway is going to have a return of capital, because the money that she had already put in there after taxes is not going to be taxed again. So when you guys are taking this $3,000 out, what you should ask the insurance company is how much of the $3,000 that you're going to get is going to be taxable, because maybe only 1,000 of it's taxable. So then that would be multiplied by your tax break. You're in your brother's tax bracket, and if you're in the 10% bracket, you're talking about $100 in taxes, which means that probably you can absorb it into your final tax liability when you do your tax return April the 15th. Would you agree with that, Chris?
Oh, definitely. I was going to say, yeah, if 1,000, because normally they pay the taxable up front on annuities. So
Yeah, what we always say with annuities, it's the gain that's taxable. So
Right.
whatever Mom.
So all you have to do is call the insurance company and say how much of this money that's left is actually taxable. And then you just multiply it by your tax bracket. That would be the tax liability. It looks like it's going to be such a small figure, because even if the whole thing was taxable, $1,500 and $1,500, if you're in the 10% bracket, it's $150. So I guess I wouldn't worry about it.
Okay, good. Can you?
All right. And again, once you get that figure, you can call us at the office, and we'll tell you exactly what the liability is.
Mark, were you going to say something else?
Yeah. Can you give me some idea what is the ranges of the tax brackets? Like 10%, what's the income range?
Well, this is after deduction. So basically, if your taxable income is like under $14,000, and so if you had income of $40,000 and you take off your personal exemptions and standard deduction, now you're down to around 20. So that would be about 15%. So you probably are going to pay, unless you and your brother are very wealthy gentlemen, are probably going to pay 10-15%.
And it depends
on the annuity.
Yeah, and the tax rate depends if you're married and all that too.
Right,
So
that's true.
if you want to call us at the office, Mark, on Tuesday, we're closed on Monday for the holiday. We'll go over the tax brackets for you.
Okay. What is your number, please?
It's 632
632
7886.
7886.
Right.
Thank you.
All right, you're welcome.
You know,
Okay.
and sorry, Esther.
No, that's right.
When we were walking into the studio, Jeff said, hey, this lady keeps calling us about questions about an annuity, and she just inherited one. So I'm feeding off of Mark's question. She didn't know what to do with it. And Jeff told her, you have the three options: taking it all up front, taking it over 5 years, or spreading it out over the rest of your life. Those are the three options. Her insurance broker said, oh, just keep it in there. It doesn't matter. It wasn't your spouse. You're not related. You don't have to take a distribution. That was totally wrong with the insurance. So if you have any questions about inheriting stuff, please give us a call. Let us tell you the right way so you're not shocked come
That's
tax
exactly
time.
right. Because once you get the 1099-R, it's too late.
Yep.
That's the official reporting form. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Can we sneak Julie in here?
Sure.
Hey, Julie, how can we help you?
Hi, Esther.
Hey.
It's a great show.
Thank you.
I have a question. I bought a single-family house 18 years ago for about $200,000. I just sold it for $400,000.
Okay.
And I'm replacing it with a townhouse that cost $300,000.
Okay. And this was your house, Julie?
Pardon?
Was this your personal home?
Yes,
All right. And are you married or single?
married.
All right. So why don't you tell Julie the good news? She'll be thrilled.
Well, the good news is if that's your primary residence and you lived in there for the last 2 out of 5 years, you don't have to worry unless if you're married, the gain is more than $500,000. And in your case, it sounds like 200, the maximum. So you're fine. And
so you're going to pay no taxes, even though you didn't even, it used to be the old law was that you had to buy a home of greater or equal value or else part of it would be taxable. That was 20 some years ago. Now, if you lived in it 2 out of 5 years, the gain up to $500,000 if you're filing a joint return, or $250,000 if you're single and you lived in it 2 out of 5 years, is going to be completely tax-free. So you should be very happy, Julie. None of it's taxable.
Yay!
Yeah.
Exactly. Real estate has really been good in this area lately. So
that's exactly right. Well, congratulations on your sale and your new house, and you don't have any taxes.
Thank you very much.
All right, thank you, dear. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. We're going to take a short break, and we'll be back with your questions and the proposed tax law changes and how to make taxable income non-taxable after the break.
Just like the one-winged dove sings a song, sounds like she's singing.
Hey, this is Esther Gulius, the tax lady, and we're talking about taxes and all the stuff that's happening. I'll tell you, it breaks your heart what happened down at in Texas with Harvey. Oh my gosh, my cousin has a house on Padre Island. I think he used to have a house on Padre Island. Anyway, I called. I've been trying to track him down, and I got a hold of his brother today, and he said that they drove down there, and they haven't been able to raise them for the last 2 days because the cell phone towers are down too.
Oh, God, you scared me. That's terrible.
Yeah, I'll tell you. But anyway, we want to talk about school. School's coming
Yep.
up, right, Chris?
Our tax school starts about October 12th, 13th, so pretty soon, and it meets twice a week, either in the mornings or evenings. The class is free of charge. You do, however, have to purchase the book and the workbook, which total about $100. There's also an online option if going to the classroom doesn't fit your schedule. And also we have about 10 or 12 scholarships. So if you can't afford the books or in the software, you just write a little 200-page story.
200 words.
200 words. That's it. That's it. And telling us.
Hey, they want to add to the tax law. Come on.
That's right.
So it's a great opportunity. The hope is that we get staff and employees from it.
And you can register right online.
Yep.
Go to egtax.com, and we have our tax school link, and you can register right online. And again, if you needed that scholarship, just call us at 632-7886 and say, gee, I'd like to go, but I just lost my job, and and
don't forget that 200-page essay.
That's right. And then the other thing, Mike and Glenn were talking before, Mike Hayflick was talking before our show about how they have segregated specialists. Well, at EG Tax, we do too. We have, like our commercial said, we have an offer and compromise attorney right on staff. So if you're somebody that has an unpaid tax liability and you're unable to pay it, we have our own specialist right on staff that'll help you with offers and compromise. And national firms charge thousands. We charge like 100
and then
to get it going, and it's just very he does an absolutely great job.
Yeah, and then I also wanted to say, for some reason, every week we do somebody who hasn't filed in 3 or 4 or 5 years, and so we seem to specialize in prior years. And before you do an offer and compromise, you have to clean the slate and get all those returns done.
Absolutely. And then the other thing is we help people with their health insurance.
That's right.
Right? So we have 2 navigators that are on staff to help you if you are unable to get health insurance or your health insurance is very high. Many times there's an exception so that you can get out of your employer's plan and maybe go into something far more cost effective. So again, EG Tax not only helps you with your your taxes, budgeting, your
FAFSAs.
FAFSA forms, offers and compromise, health insurance. We want to be there for you to help you with whatever situation. And again, like I always say, you can be at a party and you could be talking about taxes. You can just kind of email your tax question into me at egtax.com and I'll answer it almost immediately. So you can get instant tax questions answered. We wanted to talk about, though, if you were somebody that was affected by Harvey, there is an opportunity to borrow, like if you have family members down in Texas or in Louisiana, they can borrow against their 401k plan. That was just recently announced this week, right, Chris?
Right. You can do almost an immediate borrow, which is unheard of. Normally it takes about 4 months for the paperwork. They're going to push the paperwork through to get you your money, and you can still contribute to your pension at the same time if you're still working, where there's normally a 6-month wait for that. So they're trying to help out. The government's loosening some strings there. And then also, you heard us talking about this up here with our flooding we had on Lake Ontario, doing the casualty form and recouping some of the money back on your 2016 return.
Right. So what happens if you have a loss, if you know, like my cousin who used to have a house down there, if they didn't have health, whatever the loss is, let's say his house was worth $400,000 and he's able to recoup $100,000, he has a $300,000 casualty loss then.
Yep.
You know, not taking into consideration land value. That would be a tax deduction, and he'd be able to do a net operating loss, obviously, in most situations. So you'd be able to get back something from taxes as well. Speaking of taxes, and again, 8030930, 8030930, star 930 on a cell phone. Wanted to talk about some of the proposed tax law changes that they're coming up with. They're looking at dropping the top rate on corporations from 35 to 15%. That would be great. They're talking about moving the tax brackets into 3. That's not that much in simplification, but the top rate would stay 35% instead of 38. And the standard deduction will go to $24,000. Well, it's interesting. It's $12,700 now, married filing a joint return with $8,100 in personal exemptions. So it's like $21,000 now. So that's not much of a change. The other thing is, and this is a big change, they're talking about moving all pension plans and IRAs to Roth type. So that would mean that if you had you were putting $10,000 away into your 401k plan, that would have been pre-tax dollars. And if you're in the 25% bracket and 8% with New York State, you'd save about $3,300 in taxes now. If they move it to Roth type, that doesn't help, right?
No.
Chris?
No, you pay the tax now. And, where a lot of people use that, too, to help qualify them for other credits that out there that are income-based. They reduce it. People use it now for cost for health insurance to keep their AGI down. So,
Boy, that makes me scratch my head and think that the government really wanted us to do Ross all along. Because now they're forcing our hand.
It's true, because it's a deferred program. And let's face it, anytime, like I've always told people, defer, die. The federal government doesn't want you to, they want your money up front so that they can later on change the law. So if they eliminate the 401k deductibility and IRA deductibility, think about that. That's a lot of extra money in the coffers of the federal government. So that's how they're going to offset some of these reductions in tax law. So that'll be interesting to watch Congress come up with what they're going to come up with. But of course, when you listen to Ask the Tax Lady, we will keep you abreast.
Wow.
Right?
Yep. Before the show, we were talking to Jeff about that and Mike about what they're proposing with the Roths and IRAs, that just to convert them all to Roths, which is just bewildering.
Well, and the other thing is people that had that would have had pre-tax and after-tax, so there's going to be all like general rule, is part of it'll be taxable, part of it won't when they start taking it out, because it'll be years before the whole thing would be tax-free. All right, why don't we go back to the phones and talk to Mark. Hey, Mark, how can we help you, sir?
Hi, dear. Love your show.
Thank you.
Back over the STAR program.
Yeah.
My mother-in-law just bought a house. She's 85, and she's in the star and enhanced star.
Mm-hmm.
How will that affect her bill?
That shouldn't have. It should automatically come right off because of the enhanced star. It should reduce her property.
But she has to go to the city to apply.
Yep.
Right, but she won't get a check in the mail?
No, because she'll get the reduction of taxes right
Because
away.
she's she's in an enhanced star. But people in regular star, they're the ones that get the checks in the mail.
Who does?
People that are in regular star.
Under 65.
That just bought a house under age 65.
Okay, thank you, dear.
Probably like Mark. Yeah.
Probably like Mark.
Well, he would get a
All right.
check.
But he'd get a check, maybe.
Right, that's what I meant.
If you're nice. And they
That's
like
what I meant.
Right?
And they have money.
And they have money, right. I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. Let's talk about what income is taxed and how, and we're going to talk about how to make some taxable income non-taxable. Bartering income. So if I say to my friend who's got a snowplow, will you come plow my driveway and I'll do your taxes for free? What does that mean?
That's taxable income.
For both of you.
Yep.
So if it would cost $500 to do his tax return, and it was $500 for the snow plowing, the $500 that in services, in our exchange of services, that would be $500 taxable to me and $500 taxable to him.
Correct.
Right. And it's like the third question on an audit. Do you barter or do you belong to a bartering club?
Right. Because it is taxable. Now, debt cancellation. Let's say I got a MasterCard with $25,000.
They're playing the music.
Oh, I gotta shut up. Well, we're gonna let you know what to do on the other side of the news with that MasterCard that they forgive because it may not be taxable. I'm Esther Goulias, the tax lady. See you on the other side.
Sugar pie.
Hey, that's back in the old days. Frank must be looking at in the archives for that kind of stuff.
He took out the vinyl.
I'm in love with, yeah, that's good. Anyway, I'm Esther Goulias, the tax lady from EG Tax. We want to help you with your taxes, your finances. We want to clarify any questions you might have. 4 months till January. That's depressing.
Esther.
Yes,
I was thinking about the old stuff, and I just helped my grandmother move into a new place, and she's like 94, and she's in the place, and she's like, I just don't like this place. It's too old looking, and I guess she has some bad feelings about being old, but I guess she's old too. It's just funny.
I know. Isn't that something? Well,
yeah.
At least she's trying to stay relevant.
She is.
I mean, that is, as I age, that is the challenge, to stay relevant.
Yes.
So, especially with electronics, right?
That's right.
You just got to really work at it. All right, so we're talking about what's taxable and what isn't taxable. Okay, so here you got this $25,000 MasterCard. You're falling behind. You're just making minimum payments, and so you basically call them up and say, will you accept a lump sum payment, and you pay them $5,000 and they forgive $20,000. What will they get at tax time?
They will get a 1099-C, a cancellation of debt.
Right, and the IRS looks at that cancellation of debt as taxable, correct?
Correct. Line 21, income.
Right. However, is it always taxable?
No.
Right, and this is very important. And if you've claimed it last year or the year before that, and you were insolvent or had gone through a bankruptcy, it's not taxable. And so you have a form you can do to get out of it, and that would be Form
982.
That's right, 982. And so here's the thing. So at the point in time that you had the debt cancellation, what you have to say is, what were my assets? What kind of assets did I have? And let's say this person with the $25,000 in credit cards had no assets except for used clothing, right? And they don't own a home. They have maybe a car that's loaned up to its eyeballs. And so when they take a look at the debt, which was the $25,000 on the credit card, and the car, which might be another 10, they have $35,000 in debts. And if the asset is, let's say, $9,000 on the car, then that means they have more liability than they have assets, and therefore they are insolvent.
Yeah, and this is a really good example. I'm taking care of this client, and we always say, if you get a letter, call us. If you get a letter, call us. Well, about a year ago, they got a letter, and it was related to them not including a 1099-C, cancellation of debt. And so what the husband did is he just started paying it on an installment agreement because he didn't have the money. And then they came and saw me. And so now we're trying to undo it, and it's much harder this way.
Right, because then they say, can you please prove what you have here on your 982
That's
form?
right.
And so, but here's the thing, cancellation of debt, you know, when many times you'll see these commercials on TV and they're so misleading, they'll say, they don't want you to know that you can have your debt forgiven. Yeah, well, if you have your debt forgiven, they send you a form. But if you truly were insolvent, you had more liabilities than you have assets, then part of it or all of the debt can be made non-taxable.
Yep. Oh, I know. I had this one client just this summer, and they got that letter, and I'm asking them questions about, you know, what do you own your home? Do you own a car? And the wife got so mad at me and said, "This is personal information," and she stormed off. And I told the husband, "I'm just trying to help because
Save you money.
Yeah, I mean, if you want to pay the government this $5,000, you know, be my guest. You can leave too, but I'm trying to save you that $5,000." And he stayed and got her calmed down, and
because it is embarrassing. You know, that's one of the things that we do is we're dealing with people's finances, and it is embarrassing because it looks like maybe you're poking at how they paid their bills. That isn't it. We're digging for deductions, right?
Yep.
We're trying to save you money. Okay, wages. I think everybody knows that wages are taxable, right?
Yep.
That includes back pay. That
Severance.
includes severance packages and non-deductible moving expenses, right? That's all taxable. However, if you're an employee that gets reimbursed from your employer and they just give you, let's say they give you a flat amount of $400 a month because maybe you have travel that you go to branch offices for your employer and they give you a flat amount, or maybe you're an outside salesman, because that's not on an accountable plan, that's also taxable. But how can we save this person money by just changing the way they get paid?
Asking them to do an accountable plan.
Right, which means what? That sounds like it's hard, but it really isn't, right?
No, it's
they fill out an expense report.
right, which they have to do anyways for their tax return.
That's true, in order to offset the taxability of
Yep.
the non-accountable plan.
Yep, and how it saves money too. You know, people don't realize there's a nasty beast out there called the AMT.
Right.
So if you're in outside sales, you're in an unaccountable plan, and you have $40,000 worth of write-offs a year, that AMT is probably going to kick in, and you're going to pay extra taxes.
That's exactly right. And here's the thing. It makes it sound like, oh, you're in an accountable plan, and that sounds like you have to move heaven and earth to take advantage of the change to go from a flat rate to an accountable plan. Really, it isn't. You just have to talk to your employer. The employer would then have to say everybody has to fill out an expense report. You put your mileage down, you turn it into the employer, then they write you a check. That check is not taxable.
Right, right.
But if you just get a flat rate, it's taxable. So it's very important how you get reimbursed, especially if you're an outside salesperson or you're getting reimbursed for expenses.
So it may be worth it to take a $20,000 pay cut to go on an accountable plan.
Because of the AMT.
Yep.
And that's
Right?
hard for people to wrap their head around.
And that's part of what we do. Like we got 4 months till January. This is the time to come in. Let's sit down and go over your figures, because now we can affect changes. But after the die is cast, it's pretty difficult.
Right, right.
All right, the other thing is, how about if the employer is paying your education expenses? Is that taxable?
Up to the first $5,250 is tax-free.
Tax-free. So if you have an employer that says, gee, we'd like you to go get your CPA and we'll pay for it, that's tax-free if it's an employer-provided plan. It has to be through the through the employer's cafeteria plan, though. Correct?
Correct.
So so you'd have to get the employer involved.
Yes.
All right.
So
I want to give the phone number. I'm Esther Golias, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone. You were saying, Chris.
I was just going to say, if you're in the accounting field and, you're going to now go to be a lawyer, your employer probably won't pay for it. So you got to, it's to help better their company. That's why they would offer to pay for your education.
Absolutely. How about gambling? Gambling taxable?
Yep.
Now,
And
this is something people are always, they don't understand. Gambling goes on line 21. All the income you receive is reported on page 1 of the 1040. Where do you take the expenses?
the itemized deduction Schedule A, and that's where people get confused. They think you can just subtract it off of your winnings from the get-go, but you can't.
No, and if you don't itemize, how much does the taxpayer get stuck with?
All of it.
100% of it.
Yep.
So the income from gambling is miscellaneous income. The expenses that you incur, all the losses that you incurred, is an itemized deduction. It's not subject to 2%. But if you're a non-itemizer, let's say that you got $8,000 gambling, and your losses are $8,000. But you go to the Schedule A, let's say you're renting, you have no medical expenses to speak of, you have no property taxes, you haven't given much to charity, and so the only expenses you have is $8,000. That's under the standard deduction. So you're going to pay the taxes on the full $8,000 that you got.
Yeah.
And what can it do to your Social
Well,
Security?
that's what I was going to say. Unfortunately, a lot of times people who gamble are senior citizens, and it's going to make so much more of your Social Security taxable.
So not only do you get, it's like adding insult to injury.
Right.
Not only do you have to pay taxes on the gambling, even though you lost the money, but it also makes your Social Security more taxable.
Yep. So you pay more taxes on that as well.
Right, and so husbands are looking at wives and say, "I told you, Thelma, we shouldn't go to the casino."
You know,
Right?
what's so funny is with that Powerball where the person just won $760 million. Oh my God. Right away, it was somebody from the state of Massachusetts was right there, and they're like, "We're so excited." I'm thinking, yes, because the state of Massachusetts just probably got about $80 million
That's
they
right.
weren't
Ain't that
counting
the
on.
truth? That's exactly right.
You know?
Exactly right. All right, and how about inheritances? Are those taxable?
Depends.
And that's the truth.
You trained us
It depends
well.
on what kind of income you get from the estate. So let's say grandma passes away and all she had was a savings account, all right? And you inherit the savings account. Is that taxable to you?
No. Tax-free.
That's right. But let's say grandma had stocks and bonds. Is that taxable to you?
The initial inheritance, no. What you
But-
do with it can be.
Right. So let's say when grandma passed away, her investments were worth $100,000. You inherited them, so you get a stepped-up basis. So they come to you for $100,000, and let's say the stock market continues to grow, and you sell them at $150,000. There'd be a $50,000 gain down the pike.
Right. And
But
this, I'm sorry, Esther.
That's right.
This is where good tax planning comes into effect, where you may have mom or grandma, dad, grandpa, who has a stock that is worth $100,000, but they paid nothing for the stock, or we'll say they paid $10,000 for the stock. So if they were to cash it in, they would have a $90,000 gain. Where if they just let it sit there and they pass away and then the person inherits it, they get the stepped up basis and they sell it right away, the government gets no money.
However, let's say grandma and grandpa are their only source of income is Social Security and maybe a very small pension, and they did have a $90,000 gain on stock. what tax bracket would they be in?
Well, it depends if they were to sell it all or part of it.
But if they tax plan, they could get away with paying zero in
Yep.
taxes, right?
Yep.
Yeah.
Because if you're in the 15% bracket or less, you pay 0% on the capital gains. So that really gives you two options, whether to have it go into your estate or maybe systematically sell it and take advantage of the fact that you'd pay at 0%.
Right.
That's right.
Right? And again, that means you have to plan.
That's right.
I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. We're going to take a short break, and we'll be back on the other side. Oh my God, Frank, I'm not that old.
I wanted to
I don't
say
even know who that is.
there was
I have
somebody,
no idea.
Esther, that was doing their own tax return, and they came in a few weeks ago, and I noticed that they had sold some stock that they had inherited, and there was a pretty decent sizable capital gain. But when they did their own return, they, not to toot anybody's horns, but they actually did it as short term. When I amended it and did it as long term, they were in the 15% tax bracket, which meant they paid 0%, and they got a lot of money back, and they were really happy.
Yeah, I know. Well, that's that's part of what we do. We want to reduce your tax liability.
And then I just another little story. I did an amendment yesterday for a lady. She's like, I just want you to review my last 10 years of returns. So that's what it was in the appointment book. And I said, well, the statute is only 3 years. But her son came back from the military. He was 26 or 27, and he wasn't making any money. He was just going back to school. And so I amended her return and added him as a dependent.
Oh, that's
put
great.
some
Head of the household.
head of the household, and she got many thousands of dollars back.
Cool. And I will tell you, if you're sitting there in the last 3 years' returns, they're still open. Have us look at them. There's, Tiffany and Chris and I are pleasant people. We'd love to sit down and talk to you, give you a cup of coffee, right? All right, other things. Pensions are taxable, right?
Yep.
But how about on New York State?
The first 20,000 is excluded. If you're a government or state employee, then it's all tax free.
Right. So if you're over the age of 59 and a half, the first $20,000 on New York State for your pensions and annuities are tax free. Mm-hmm. And if you are a retiree, federal, state, local municipality employee, all of your pensions tax free. So if you've been including it on New York State, this is all in New York State, by the way, then you should amend your return because you got money coming back. U.S. savings bond interest, is that taxable?
Taxable to the federal, tax-free on New York State.
New York State, right. And if you have municipal bond interest, like you have New York State railroad bonds, is that taxable?
No, it's not on neither.
On federal or state. What if you had Colorado bonds?
Colorado would be taxable on
tax-free federal.
Right, taxable on New York.
State.
Yep.
Right?
Yep.
How about insurance claims and lawsuits?
Well, if it's insurance, that money that you receive for casualty and loss, I mean for calamity, it's not taxable generally.
For calamity? What do you mean calamity?
But if it's for lost wages,
where in the tax law does it say for
calamity?
Well, isn't the whole tax law calamity?
Yeah. So if
lost
it's for
wages, it would be
injury,
right?
If it's personal injury, like Salino and Barnes, and all those guys that are helping you because of personal injury, your leg was broken or whatever. For personal injury, that's completely tax free. But if it's for but if it's for lost wages or a discrimination or breach of promise or invasion of privacy, that's taxable. Right?
Or if you're a whistleblower and you get money, that's taxable also.
Right. Life insurance, is that taxable?
Not payable upon death.
Right. How about the interest if they say, you know what, gee, Tiff, we think that you should keep that here with us. We're going to take such good care of it, and we're going to give you 4% interest. Would that be taxable?
Yes.
Right. But the life insurance is not. Okay, an annuity, we talked about annuities today. Annuity sounds like it's insurance, but it's not life insurance. Annuity is another investment vehicle. And so the money you put in that are after tax is not going to be taxable, but all the money that grows from the time you put it in. Let's say you put in 50,000 and it grows to 100,000. Then 50,000 of it is basically tax deferred income that's going to be taxable when you take it out. Correct?
Correct.
Okay. Okay, then how about, let's see, wage replacements, unemployment, and sick pay? A lot of people think unemployment's not taxable, and there's something you really got to watch out for, isn't there, with New York State?
In 2015 and 2016, New York State stopped mailing you the 1099-G, and you had to go and get it electronically. But a lot of people didn't know that they stopped mailing it out, and so when they filed their 15 or 16 return, I mean, life gets crazy and calamities happen. And so you forget that you got unemployment, and so they didn't include it on the return.
And so then they get a bill.
IRS will let you know.
So just FYI, if you know when you're doing your tax return that, gee, I have other income here, but they didn't send me the form, that doesn't get you off the hook at all.
Right. Because if you didn't get it, IRS did, and they're going to know a year later.
Right, and then they're going to penalize you. So you want to make sure that and if you need help, you can like when we do the return, if we say, did you get unemployment, we'll go right to the website and we'll download it. So it's right
Yep.
then and there. All right, how about workers' comp? Is that taxable?
Tax-free.
Completely tax-free, right?
Yep.
So if you're on workers' compensation, that's tax-free, and if you've been including it on your tax return, that's incorrect. How about executor fees and notary public fees?
Taxable.
Yes.
Right. And scholarships.
Taxable.
Well,
Beyond.
All right, maybe
Right.
it's tax-free. When is a scholarship tax-free?
when it's used for education.
For a
Degree candidate.
candidate, right?
Yes.
So if you're in a degree program, you're going to get your bachelor's degree, and you have a scholarship, and it's used for education. How about if you then it's tax-free. How about if they give you $20,000, the cost of the education's $8,000, and you got $12,000 for housing?
Taxable. It's a calamity on your tax return.
Right. That would be taxable, right?
Yes.
Right.
And a lot of times parents are claiming the kid on their tax return, and the child ends up paying taxes on it. Would this be considered kiddie tax?
I was just going to say that. Yes, it does count as a kiddie tax. So the child claims it on the return, but they're going to pay tax at the parents' rate.
Right.
Yep.
Yeah.
And the parents just go, oh my God. I had one couple that, oh, there's my phone.
And then don't forget, Chris just looked at a return the other day, and they included scholarship money, but they forgot to take the books and supplies. And so don't forget to save all your receipts when you're in school to do those books and supplies as well.
All right. Now, and it's really important that you pre-plan. And have these conversations with your kids if they're getting excess scholarships, more than the cost of the education, that you would understand that at tax time, those kids are going to pay taxes on that. So it's good for you to know that they should set aside some of the money that they're getting, because it is taxable. How about Peace Corps payments?
Well, Peace Corps for oh boy.
If it's paying for living expenses, it's taxable.
Yes.
Right?
Yep.
But not if you are a volunteer. And how about public assistance?
That is tax-free.
And how about health insurance payments paid through the employer?
Tax-free.
Tax-free.
Right, which is really remarkable when you think about it.
Yep.
Yeah,
And
because
what about health insurance paid for through the government, through the exchange?
Right, now that's really important. If you're getting a subsidy through the exchange, that may be taxable.
Yep.
Even though right now it feels so good, you don't have to pay those payments, and you're thinking, this is so cool. At tax time, it all gets reconciled out. And you can see with our senators and our representatives, who are gutless wonders, haven't been able to do anything with Obamacare and everything. It's still in the tax law. So if they don't do anything before the fall term is up at Christmas time, then if you got a subsidy, you reconcile that when you're doing your tax return. And if you got too big of a subsidy, then it's taxable and it's part of your tax liability. So what I'd suggest you do right now is, if you had a change in your financial situation when you applied for the health insurance, you weren't working, but now you are, should you just go on and let that subsidy continue?
No. Lessen the blow and make the adjustment so that come tax time, you're going to have less of a liability due.
Because it can be devastating.
I just had a client who was a subsidy person, and in October he took a job overseas, and the company reported to that country were $20,000 worth of moving expenses. So I had to put that on the U.S. return. It was in December when that was reported, but that impacted his subsidy, and he had to pay back $1,800 to the government.
Right. And so all of these, I guess this is what I would take away from this show. If you heard something that you say, gee, maybe we should have this looked at. We are getting subsidies. Our financial situation is more than we did when we first signed up. I'll tell you, EG Tax is here for you. You can always go to our website at egtax.com and ask the tax lady. I'll answer it right away. Or you can call us at 632-7886, and we'll be very happy to help you. Until next week, I'm Esther Gulias, the tax lady, with Tiffany Fabian and Christopher Fabian. Have a wonderful week. Have a great Labor Day. And let's hope the hurricanes stay away. Bye-bye.